What is up, people, and welcome to episode 5 of the Day Trading Bootcamp. And today we have my favorite lesson of all, and that is the lesson on fair value gaps. Fair value gaps are hands down the most important confluence in my model. I use them every single day, and I use them in 2 different ways, of which I will cover in this video. After this video, make sure you are testing these and going over them on the charts for yourself, because hands down, you will need this the most if you plan to trade my model and plan to trade inversions how I do. So, welcome back to the charts, and welcome back to my beautiful drawings, and my drawings will cover exactly how to mark out a fair value gap, what it is, and then we'll talk a bit about how they are used and why they are there and why they are important. So getting right into it, what a fair value gap is just a 3-candle pattern. That's all it is 3 candles put together. And what the fair value gap is within those 3 candles is the gap in between the wicks of the 2 candles. All right, let's get right into how to mark out a fair value gap. So all a fair value gap is the space in between 2 wicks where there is no wick or no body of a candle, and there is just a gap there. Hence the term fair value gap. So you can see right here, for a bullish example, we have a gap in between these 2 wicks, the lowest wick of the 3rd candle and the highest wick of the 1st candle. So what you have is a gap between them, and this is where you have your bullish fair value gap if it is a bullish candle. Now, of course, this candle could be red, this candle could be red. It doesn't matter. As long as the middle candle is green, it's a bullish fair value gap. Same thing for a bearish fair value gap. What we have is a gap in between the lowest wick on the 1st candle and the highest wick on the 3rd candle. We have a gap between them, and that is where we have our bearish fair value gap. Now, what are these and why are they important? So what a fair value gap is an imbalance of price or orders. Why they are there and why there is a lot of orders are there is because these occur when there's a flush move in price. So you can see if price moves up very drastically, we leave a space in between these 2 candles because price moved up so violently and there was a bunch of orders that got filled and we sent price in a certain direction. So what we have in this gap are tons of resting orders. Going back to our liquidity video, why are orders important? Because they are what send the market in a certain direction, and orders normally get traded back to because they want to be filled to continue moving price. So what happens with these fair value gaps is these are commonly traded back into and reacted off of because there are resting orders which get sought out, and then these are usually held, respected, and price will continue up. Same thing if we have a bearish example, price can commonly be seen trading back into these fair value gaps and sending price in that same direction. All right, I prepared for us another beautiful work of art. So an example of a fair value gap being formed and respected would look something like this. Price is trading up in an uptrend, trades back down, leaves a fair value gap, and then this fair value gap gets held, respected, and continues higher. Same thing again, we form another fair value gap, gets traded back into, this fair value gap gets respected, and because there's all the orders there, it gets traded back out of because this fair value gap holds. Same thing on the downside, you get the gist. We're in a downtrend. Price forms a fair value gap, gets traded back into, continues. Gets traded back into, continues. You get the point. Now, another thing that can happen is there's not enough orders in these fair value gaps, and they're not strong enough, or price is moving too fast in the opposite direction, and these fair value gaps get disrespected. So what that would look like is if we're in an uptrend, you see our bullish fair value gaps, they get traded back into and held, get traded back into, and then instead of getting traded back into and held, they get traded right through. So they get disrespected or inversed. This was a bullish example, and then a bearish example, same thing. We're in a downtrend, fair value gap gets traded back into, respected, and then fair value gap down here gets traded through, and we inverse it running to the upside. Now, combined everything we've learned so far. So we have our market structure, we know we're in an uptrend, and then you see your market start to form lower lows, lower highs if you're in an uptrend, and running through fair value gaps. This is a sign that price is flipping direction that you can add to your market structure lessons that you have. And you can see these inverse fair value gaps showing you that price is switching directions and order flow is switching. Same thing bearish. If we flip to the upside, we start forming these higher lows and higher highs running through these fair value gaps, flipping direction of price, inversing these, showing you we're flipping order flow. Now, how do you know if a fair value gap is inversed or disrespected? This is a little bit more complicated than just seeing if price is trading through it or not, because this is when you have to know what the candle itself is doing. So if this is a candle to the downside and we have a bullish fair value gap, you see it get held, you see it get traded out of, and then you see it start to move through this candle. Just because this candle reaches or goes through the bottom of the fair value gap doesn't mean it's inversed. What you need is to have a candle, a bearish candle specifically, close through the fair value gap. So what close through means would be the body of the candle closes through the fair value gap. So if your candle looked like this and only the wick came out of it, This fair value gap is not inverse because the body didn't close through that fair value gap. But if the body were to close and it were to look like this, and then the wick was down here, that fair value gap is inversed. I can't stress this enough. The candle body has to be closed through the bottom of the fair value gap, but it also has to be on the same time frame that the fair value gap was formed. So if this was a 1 hour bullish fair value gap, this candle that closes through it has to be a 1 hour candle. It can't be a 1 minute candle. Same thing to the upside. If you have a bearish fair value gap, you have to have a bullish candle on the same time frame close. The body has to close above the fair value gap. Remember, if the candle closes down here and it only wicks out, the fair value gap is not inversed. It's not inversed until the body of the candle closes above the fair value gap. Now, I know you love my beautiful artwork, but let's look at this at the charts because it's going to be a little bit easier for you to tell there, and that's where you're actually going to be using it. All right, so I'm going to start off in the hourly time frame. So you can see right here in just this area of price, we have a mini uptrend. And what you can notice here is we formed a bullish fair value gap. So we formed this bullish fair value gap, and you can see this candle trades into it, and it gets respected. This candle starts moving down, and we see this candle right here close below this fair value gap. That's a sign that the fair value gap was inverse, so this is now known as an inversion fair value gap, showing you that this gap is no longer relevant. You can forget it happened because we traded through it, and we're probably flipping order flow to the downside, which we did, carrying on lower. But just this candle right here, traded into it, that's still respected. It doesn't matter. All right, now here's an example of a bearish fair value gap. So we see we have this little downtrend here, and we form a bearish fair value gap. So we see the candle trade into it, and then we see this candle wick out of it. Is this fair value gap inversed yet, right here on this candle? No, it's not, because no candle closed above it. We didn't get a closure above this fair value gap until this candle on the same time frame closed above it. All right, let's practice. I'm going to mark out the most recent fair value gaps, and we'll do a little quiz to see if you can figure out if they're inversed or not inversed, respected or disrespected. So what I see right here is we have a bearish fair value gap. So if I let price play out, you will see the next candle does not touch the fair value gap. No, I'm not worried about it. This fair value gap hasn't gotten traded back into. There's nothing to see here. But then bang, price comes up and trades through the fair value gap. This candle is still inside the fair value gap, so this fair value gap is still holding. But once we get to this candle, this is where the fair value gap would be inversed. So now we know, okay, we're probably flipping order flow to the upside because we ran through this gap. But when this happened, what did we see? Two new fair value gaps get formed. We have a new bearish fair value gap there, and we have another one right here. Let's see if price trades into, inverses, or respects these two fair value gaps. Bang. First fair value gap inversed. Now you might be thinking, that's an inversion. We're flipping to the downside. No, it doesn't matter because we traded right back into another fair value gap. Okay, what does this tell you? You know there are orders in a fair value gap because there's that gap in price where all those orders were left behind. So even though we inverse this fair value gap, we're not confirmed to be in bearish order flow because we haven't traded through this fair value gap yet. We could be still in bullish order flow. I let price play out a little bit more. We formed two new fair value gaps. There and there. Let's see what happens. Bang. Fair value gap inversion. We inversed both of these fair value gaps because we saw a body closure through them, showing us we will probably go lower. Okay, that is fair value gaps, and you can use these to figure out your kind of general direction you know price is going into, and you can use these to spot areas of liquidity because there are orders in these fair value gaps, which means there are liquidity in these fair value gaps. You use these to spot the direction of price and where price might be heading based on whether these fair value gaps are being held or being disrespected. Now, that being said, these fair value gaps form on all time frames. So this can be on the 1 minute time frame, this can be on the 5 minute time frame, this can be on the 1 hour time frame. All that matters is you can see where on that time frame order flow might be going based on whether these gaps are being respected or disrespected. Now, what you have to do to get good at this is go onto the charts for yourself, go onto the hourly time frame, go onto the 4 hour time frame, and start seeing these fair value gaps get marked out and see if they are being respected or disrespected. practice this and combined it with what you know about liquidity and what you know about orders and what you know about market structure and trends. And now you kind of have multiple confluences to add to your toolbox to figure out which direction the market is heading in.